This question tests students' understanding of non-cash transactions in the statement of cash flows. The key phrase is acquired land by assuming a mortgage for the full acquisition cost. Since the company obtained the land by taking on a mortgage rather than paying cash, no cash was received or paid at the acquisition date. The statement of cash flows reports cash inflows and cash outflows only. However, accounting standards require significant non-cash investing and financing transactions to be disclosed separately because they affect the company's financial position even though they do not involve cash. Students should recognize that acquiring a long-term asset, an investing activity, by incurring long-term debt, a financing activity, combines both investing and financing elements without any cash movement. A. Financing activity. Incorrect. Although assuming a mortgage creates a financing obligation, the transaction also involves acquiring land. Since no cash is exchanged, it is not reported as a financing cash flow. B. Investing activity. Incorrect. Purchasing land with cash would be an investing activity. However, in this case the land is acquired without a cash payment, so it is not reported as an investing cash flow. C. Operating activity. Incorrect. Operating activities relate to the company's normal business operations, such as collecting cash from customers or paying suppliers. Acquiring land is unrelated to operating activities. D. Non-cash financing and investing activity. Correct. The acquisition of land through the assumption of a mortgage is a significant non-cash transaction involving both investing, acquiring land, and financing, incurring debt. It is disclosed separately as a non-cash investing and financing activity. Correct answer. D. Non-cash financing and investing activity. Exam tip. Remember this rule for the statement of cash flows. Cash purchase of land or equipment, investing activity borrowing cash from a bank, financing activity acquiring an asset by issuing debt or shares. No cash involved, non-cash investing and financing activity. A useful memory aid is no cash exchanged equals disclosed separately as a non-cash transaction. This principle is frequently tested in financial accounting and cash flow statement questions. This question tests students' understanding of the classification of cash flows into operating, investing, and financing activities. The key phrase is should be classified as an operating activity. Operating activities include cash flows arising from the company's principal revenue-producing activities, such as collecting cash from customers and paying suppliers, employees, and other operating expenses. Students should distinguish actual cash transactions from changes in working capital accounts. Under the indirect method, changes in current assets and current liabilities, such as accounts payable, are used to reconcile net income to operating cash flow. Therefore, a decrease in accounts payable represents an operating cash flow adjustment because it reflects cash paid to suppliers. A decrease in accounts payable during the year. Correct. A decrease in accounts payable means the company has paid cash to suppliers for obligations incurred previously. This represents an operating cash outflow and is classified within operating activities on the statement of cash flows. B. An increase in cash resulting from the issuance of previously authorized common stock. Incorrect. Issuing common stock raises capital from shareholders and is classified as a financing activity, not an operating activity. C. The purchase of additional equipment needed for current production. Incorrect. Even if the equipment supports current production, purchasing long-term equipment is an investing activity because it involves acquiring a fixed asset. D. The payment of a cash dividend from money arising from current operations. Incorrect. Cash dividends paid to shareholders are classified as financing activities, regardless of the source of the cash. Correct answer. A. A decrease in accounts payable during the year. Exam tip. To classify cash flows correctly, remember: operating activities, cash flows related to day-to-day business operations, including changes in working capital, accounts receivable, inventory, accounts payable. Investing activities, purchase or sale of long-term assets such as equipment and buildings. Financing activities, transactions with owners and lenders, including issuing shares, borrowing money, repaying debt, and paying dividends. A useful memory aid is: operating equals working capital. Investing equals long-term assets. Financing equals owners and creditors. Using this rule, a decrease in accounts payable is correctly classified as an operating activity. This question tests students' understanding of how the statement of cash flows can be used to assess a company's continuing solvency. The key phrase is continuing solvency, which refers to a company's ability to generate sufficient cash to meet its obligations and continue operating in the long term. Students should distinguish between having cash at one point in time and consistently generating cash from business operations. A company may have a large cash balance because it borrowed money or sold assets, but such sources are often temporary. Sustainable solvency depends primarily on whether the company's core operations generate positive cash flows over time. Cash balance at the end of the period. Incorrect. A high ending cash balance provides only a snapshot at one date. It does not reveal whether the company can continue generating cash in future periods. The balance could result from temporary borrowing or asset sales. B. Cash flows from used for operating activities. Correct. Operating cash flows reflect the cash generated by the company's normal business activities. Consistently positive operating cash flows indicate that the company can pay suppliers, employees, interest, and other obligations without relying excessively on external financing, making this the best indicator of continuing solvency. C. Cash flows from used for investing activities. Incorrect. Investing cash flows relate to purchasing and selling long-term assets. Although important, they do not directly measure the company's ability to sustain operations. D. Cash flows from used for financing activities. Incorrect. Financing cash flows involve borrowing, repaying debt, issuing shares, or paying dividends. These transactions provide funding but do not indicate whether the business itself is generating sufficient cash. Correct answer: B. Cash flows from used for operating activities. Exam tip. When evaluating continuing solvency, focus on cash generated from operations, not simply the ending cash balance. Operating cash flow measures the ability of core business activities to generate cash. Investing cash flow reflects long-term asset purchases and disposals. Financing cash flow reflects capital raising and repayment activities. A useful memory aid is: healthy operations create healthy cash flows. Therefore, cash flows from operating activities are the most important indicator of a company's long-term solvency and financial sustainability. This question tests students' knowledge of the methods used to present operating cash flows in the statement of cash flows. The key phrase is most commonly used method, indicating that the question is asking about practice, not merely what accounting standards permit. Both the direct method and the indirect method are acceptable under accounting standards for presenting cash flows from operating activities. However, in practice, the indirect method is used far more frequently because it starts with net income and reconciles it to net cash provided by operating activities, using information readily available from the accounting system. Students should also recognize that the single-step and multiple-step methods relate to the presentation of the income statement, not the statement of cash flows. A. Direct method. Incorrect. The direct method reports major categories of cash receipts and cash payments, such as cash collected from customers and cash paid to suppliers. Although permitted and informative, It is less commonly used in practice because it requires additional detailed cash records. B. Indirect method. Correct. The indirect method begins with net income and adjusts for non-cash items, such as depreciation, and changes in working capital to arrive at operating cash flow. It is the most widely used method because it is easier to prepare from existing accounting records. C. Single-step method. Incorrect. The single-step method is an income statement presentation format, not a method for preparing the statement of cash flows. D. Multiple-step method. Incorrect. The multiple-step method also relates to the income statement, separating operating and non-operating items, and has no connection with cash flow reporting. Correct answer. B. Indirect method. Exam tip. Remember the two methods for reporting operating cash flows. Direct method lists actual cash receipts and cash payments. Indirect method starts with net income and adjusts for non-cash expenses, gains/losses, and working capital changes. A useful memory aid is indirect equals income reconciliation. Because it is simpler to prepare and widely adopted in practice, the indirect method is the most commonly used method for reporting operating cash flows.